emergency funds, I need to have a different investment policy. For putting away money to send a child to college, you have to have a different investment policy. It's for each objective, so you cannot just pool everything in one sort of pool and say, I'll allocate it in X percent here, X percent there. That will not work. So as I said, the diversified portfolio doesn't work out. It's got to be allocation for each objective. Next slide, please. Let's say if you are a corporate treasurer and you need money invested where you can draw it out at short term, at short notice, without having to wait for it, or be locked in, and more importantly, without it being hit through price volatility, then what you would probably do is put it away into a bank deposit or buy a short-term government treasury bill. You're likely to underperform inflation. But the time period for which you're putting this money away, the loss of value because of inflation is not relevant. The more important thing is having your money when you need it. So that's the right allocation. That, in other words, you are investing in an asset which you know will underperform inflation, and yet you are happy with it because your horizon is very short term, or it's not predictable, and therefore you need money pulled out at short notice, or it's unplanned withdrawals. If you are responsible for investing someone's money for a retirement or a provident fund, irrespective of how you allocate it, and most people sort of try and figure out as those responsible for managing colleagues' provident funds, should we have 30% in equity? Should we have 15% in equity? Should we have nothing in equity? Should we have everything in government bonds? Whichever way you do it, it's going to work out wrong, because each individual within that pool has a different investment horizon. Some will be leaving the company earlier, some later. So regrettably, the current structure of investment policy that provident funds are allowed is flawed. Unless we allocate money for each individual and can then pull that out for each individual, whatever we do, we'll end up with a mixed bag, not the optimal asset allocation. There is a solution, which is the type of investments you can make in the voluntary pension scheme, which is invested for each individual, and I'll show you a slide as to how that can work well for most people. And that is perhaps what most corporates need to move to, is the individualized asset allocation structures rather than this pooled structure like a provident fund. Let's say if you were responsible for managing an endowment and you have 10 million rupees, let's say you are earning 12% per annum on it, in other words, 1.2 million per year. Assuming this endowment is looking after educating children, and you need 1,000 rupees a month for that, then the 1.2 million per year will translate to looking after 100 children education. However, your problem is, if inflation is at 10%, then 5 years down the road, that 1,000, you now need 1,610 rupees per year, per month, per child. So with that same 10 million rupees, you will now be able to support only 62 children. So typically people say that, fine, I've put away money into a government bond, I'm earning 12%, so I can use the coupon earnings and I'm fine, I've done a wonderful job. Regrettably, one hasn't, because the number of kids now goes down from 100 to 62, The others don't get that education. If you're managing your own income during retirement, now it's the same thing. You know, you retire, you get a certain pool of money, you put it on deposit, government deposit, khas, whatever, and say, fine, whatever earnings I get, I live off it. You'll meet the same fate. There's lesser mouths you can feed. Now, unless some of your family members pass away during that retirement period, you have a serious problem. So, you know, again, there are solutions. I'll talk about that. But basically what I'm saying is it's the asset allocation. It has to make sense. We can't take the simplistic view that, okay, this is what I'm earning, I can afford to spend it. We cannot, regrettably. There are some opportunities in the market even today. As Amjad had mentioned, there is an opportunity in the equity market. Some wonderful TFCs, good quality TFCs are being sold at fairly low prices, certainly below what they ought to be worth. So there's an opportunity there. Currently, the short-term treasury bill of the government is yielding better than what most people are getting on a bank deposit. So there's an opportunity there. But we shouldn't be driven by trying to pick these opportunities all the time. We cannot try and make this quick turn all the time. We need to invest according to the asset class fundamentals. That is the key to it. Don't try and pick opportunities. Stick to what is the asset class that suits this particular objective of mine. Just a bit of the empirical record of earnings. Amjad had put this in a tabular form, the same thing, different asset classes. The top one is the equity, where, as you can very well see, highly volatile, got a wonderful period, then took a drop, started picking up again. The next one online are defense saving certificates, reasonably stable, and the lower two are really bank deposits and inflation more or less going in line with each other. This is again over the last 35-year period, more or less what Amjad had pointed out. Now, clearly, investing in shares, equity, there is a probability of loss because of the volatility. Over time, this probability of loss reduces. Based on the historic data of assuming you go in and invest in all the shares in the market, not knowing which is good, which is bad, just without trying to discern between that, and just go and take all the shares. The next slide shows you, like, had you taken a one-year horizon, in other words, you started off, invested, and close out your account a year later. You don't know how you will fare, but this is what happened. Out of those 40 periods, you've got 11 periods of losses. The other periods, you've made money. Instead of 1 year, if you take a 5-year horizon, what you find is that so in other words, if you invested in 1970, you will take it out in 75, 71, you'll take it out in 76. The number of losses have gone down. In other words, the probability of loss has reduced as your investment horizon has grown. The next slide shows you a 10-year investment horizon. So each of those 40 periods of 10 years each, starting with 1970, 71, but 70 through to 80, 71 through to 81, none of those periods have shown a loss. However, the line going across is inflation over the 10-year period. And you will find that there are several periods towards the right